We're going to start now. Hello, everyone, and welcome to our first webinar. I am Tim Goodale, founder and managing partner of Keel Harbour Capital. Keel Harbour places capital for specialist private equity and private debt managers. We work with alignment-oriented funds focusing on differentiated opportunities in the middle and lower middle markets. I and my teams have worked on some 25 successful placements over the last decade. Today, I'm pleased to introduce Peter Cirenza and Peter Stein, who will be discussing current opportunities in the markets while putting the current market into historical context. Peter Cirenza is a former partner at Goldman Sachs, where he was a co-founder of their Special Situations Group. Today, he is chairman of tactical strategies and private equity at $28 billion Tikehau Capital, a leading alternative asset manager. In his spare time, he lectures at the London School of Economics. Peter Stein is a former CIO of the University of Chicago Endowment and former managing director at Princeton. Today, Peter is head of research at Keel Harbour. He also sits on the investment boards of several endowments and foundations. Let me start with technical points for our webinar. All participants will be on mute during the call, and at the end, we will have a Q&A between Peter and Peter. Please send your questions through the Q&A button at the bottom of your Zoom screen. Now I hand over to the two Peters.
Thanks, Tim, and thank you all for joining us. We're going to cover, as we said in the invitation that you all got, 4 main points. We're going to try and make some sense of the current situation in financial markets. We're going to look at the opportunity set in the credit markets, and particularly real estate and corporate debt. We're going to look at the trade-off between public and private markets at this point, and we're going to put the current crisis into some perspective and look at it in the context of other crises that we've been through over the last few decades. Pete and I have both been in the markets since the mid-'80s. We thought Pete Cirenza would be a particularly good person to address these, given his broad experience, which Tim covered, and the seat that he sits in now. Pete, do you want to tell us a little bit about Tikehau and your role there?
Sure, fantastic. So, good morning, good afternoon, depending upon where you are. So first of all, just all of us are hoping that you and your family and friends are doing well. Certainly, very challenging and unusual times we're living in, and we do hope people are doing their best as they can under the circumstances. So first of all, on Tikehau Capital, for those who don't know the firm, it's a 28 billion in US dollar terms alternative asset manager, active in real estate, private debt, private equity, and we have a European capital markets UCITS business. And then we have a tactical strategies unit that invests the Special Opportunities Fund, which is one of the aspects of today's call, and really invests in multi-asset strategies across our business lines. So Tikehau is active in Western European markets, and we have a very strong local presence that supports our investing. We have 7 offices in Europe. We fundraise globally. We have 4 additional offices in Asia and North America, characterized by a lot of equity. We have over 3 billion euros in equity, 44% of which is owned by the management. And the primary use of the equity is investing in our funds alongside our LPs. So it creates a very strong and fairly unique alignment of interests that's quite powerful. So it's very much an investment company mentality. There's a long history and experience for senior people in special opportunities, and we really do look to lever the entire firm in that process. And then me personally, I chair private equity and tactical strategies, and I also sit on investment committees for the firm's balance sheet, as well as for our other higher yielding strategies, real estate, private equity, direct lending. So back to you, Peter.
So it would seem like you're about as well placed as anyone to make some sense of what's out there right now. pretty much everything is at lower prices than it was before, but that doesn't necessarily make it cheaper, right? There's fundamentals are and maybe in tatters, but at least uncertain. And there's a tremendous amount of uncertainty out there right now. And so, you don't necessarily go bargain shopping out there for the sake of going bargain shopping. You've got to figure out what's underlying those prices, right? And so what do you do? How do you sort the wheat from the chaff in this environment? And how do you think about working with that uncertainty?
Sure. Well, I think first of all, I think some techs are up for the year. NASDAQ, I think, is up for the year, but pretty much everything else is down, and some things are down quite significantly. Obviously, we've had a health crisis that has very quickly impacted the real economy and financial markets, and the transmission between that is really faster than I think any other crisis or any experience that we have seen. Certainly, if you go back to February, March, you had a lot of forced sales and liquidations going on. Very impressive rally in equities and good parts of the credit spectrum since late March. Personally, I think that rally is not going to hold. Maybe it started turning in equities yesterday. We'll see. These things are always, you figure them out in hindsight. But to me, I think there's just been too much real damage done in the economy from the virus and the containment efforts that we've already seen. And that the recovery that we're going to have is going to be quite, uneven. It's not going to be, it's not going to be one where you get a very quick, spring back. So, for example, there was a poll in the UK just the other day that said that 1 out of 3 small size firms that has had to shut because of the containment measures may never reopen. And certainly we can all think of sectors, whether it's, airlines, rental cars, restaurants, pubs, lots of leisure, hospitality, tourism, et cetera, that are, very materially, influenced by the virus and the containment policies, and, operating with reduced or in some cases no revenues, and a lot of uncertainty. And I think the other thing you have to think about is, it's not just the containment policies, right? It's also, to what extent does this impact behavior, consumer behavior, even once containment, measures have ended. So I think in that context, it's hard for me to personally see a very, very strong, recovery in the real economy. Now, certainly central banks and governments have done a very good job, I think, in terms of reacting quickly and in great size and scale. And I think that's been very important in supporting people individually and supporting businesses, and obviously supporting financial, aspects of the financial markets. But, these programs are uneven in their application, and they're certainly unaffordable beyond a short period of time. So the notion that we can, for a very long period of time, stay in this sort of environment is definitely, not the case. And I do think that you have central bank programs that have really, possibly artificially, buoyed certain elements in the credit markets. But there's an underlying reality of defaults that are likely to be into the low double digits in high yield and leverage loans, and I think that that those are probably not being priced in the market right now.
And I think the big question, which you touched on, is the second round they did really try to get at underlying demand, but we'll see how successful that will be. That's the real question here is rates will not address this. It's underlying demand, consumer demand, that will take a long time to come back. And it's going to be really hard because it is second order and third order effects. There are a lot of small businesses, like you said, and families that had no cushion. And we know that in the long run, we will recover because we always do. Economies do and markets do. But I used to have, for most of my career, I've had 2 quotes above my desk, both of which are probably apocryphal. But it was, in the short run, the market's a voting machine. In the long run, it's a weighing machine, was one. And the other is the market can remain irrational longer than you can remain solvent. And there are a lot of businesses, and we're seeing it on this local scale all over the place, that aren't making it through this. And so that's going to depress demand in a way that's going to filter back up and make it very difficult for the large scale businesses that make up our markets. And I think that's not being discounted in the markets the way that maybe it should be. I think that's being passed over a lot.
Yeah, no, I think I'd agree with that. I think for people who have kept their jobs and kept their income, they're probably saving significantly more in containment than they did before, and it's going to be almost like a end of war, post-war pop in demand from that part of the the consumer space, if you will. But again, I think the current furlough policies and so forth are masking, a really, really high level of unemployment that I think is not fully appreciated. We see these numbers, these unbelievably big numbers of people who are in these programs, but I don't think it's been fully, again, priced into markets, and so I think that will obviously impact demand, because again, these furlough programs, these income support programs are enormously expensive for states to provide, and were a very, very necessary tool, but that you can't continue them indefinitely. And I think when we come out of that, you're going to see both people whose incomes are not secure, and then more broadly, you may find that people, just the behavior of people, they may decide they want to be saving a bit more, as a result of the experience that they just came through, even if they kept their job.
Yeah, I think there's going to be a lot of that post-war syndrome as well, the higher savings rate and so on.
Yeah.
But the other thing that this must do is it must be creating tremendous opportunity, because the markets are reacting chaotically and in some senses disconnected from both the real world and the news cycle. I mean, you see these huge rallies in the middle of the bad news, and we always say, in normal times we say, oh yeah, the markets are reacting to the forward fundamentals and so on. These days it's not even that. They're reacting, they're disconnected from seemingly anything, and so you get these big rallies in the middle of the worst news cycles and completely disconnected from any fundamentals. And at the same time, you get the crushing sell-offs, and that presumably creates opportunity for you guys. You talk some about the opportunity set now that you're seeing out there.
Yeah, absolutely. Well, I think first of all, at Tikehau, in our special opportunities approach, we're active in stress public credit, and then we're active in private credit, both on the corporate side and on the real estate secured side. So first of all, on the public side, we had this very sudden, swift downdraft, that we experienced, back, at the end of Feb into March, very dramatic. Liquidity not that deep, so not a lot of market depth. Very significant dispersion. And I think the key, certainly in that time frame, is the ability to to be able to narrow down which names you want to do work on, which names you want to try to build positions in, and because you really have to pick your spots, quite well. I think for us at Tikehau, we have the advantage that because we're a very big player in leveraged loans, we're a very big player in high yield. We're a well-regarded CLO manager. We have a very big credit research team that covers almost 500 names in Europe. So we had the ability quite quickly to sort of analyze the universe of loans and bonds that had traded down, and then to hone in, on maybe 25 to 30 that we did serious work on, and then we were able to take positions in a number of names, and there were really names that we felt had been sold because people needed to sell them, i.e., no particularly strong impact of the virus or the containment measures on the underlying business, as well as names that we felt. I'm sorry?
Babies thrown out with the bathwater, essentially.
Exactly. And then as well, names where we felt that there was, a very limited impact or a very clear path towards, towards a rebound, in those businesses, and that's how we kind of narrowed the universe down and took those positions. And what we didn't do, or what we certainly try to avoid, is any sort of position where you're making, a material bet on either how long containment lasts, or when are we going to have a vaccine or effective treatments. And in that respect, we weren't wading into those sorts of names. I think it's very much the case that we're very asymmetric risk at the moment. It's unlikely that things get better much faster than anyone is hoping for. But whether it's existing actions being taken by governments with regard to public health, or whether it has to do with testing or vaccines or treatments, or contact tracing, or the likelihood of there being setbacks and delays is meaningful. And so in that context, your risk is quite asymmetric, and you need to think about it in that in that manner. So in any event, that's how we thought about the public markets, and certainly in the context of special opportunities, it's the public markets that were generating the very initial opportunities in that segment. On the private side, we're already seeing many requests that have come in from borrowers both on the corporate side and on the real estate side. A lot of the initial corporate ones that we've seen were situations or businesses that are quite cyclical in nature, or have been heavily impacted by containment measures. So we've been quite cautious, again, because we don't think we have a great crystal ball to be able to forecast exactly how those things play out, and we certainly don't want to be making bets, if you will, on containment measures ending successfully by a particular time frame. So I think it's fair to say that on the private side, we're at Tikehau, we're patient, and we're looking to back resilient businesses. We certainly expect that there's going to be an absolutely enormous need for liquidity and capital that's going to be quite long dated. That's going to extend for several years, and so for people who have access and the ability to provide private capital, I think there's going to be a very significant opportunity. One situation that we did commit to on the private side was a major player in healthcare software that was doing an acquisition, and we were able to come in on the back of a very close relationship with the founder of the business, our ability to move quickly, to use our balance sheet to commit to a sizable north of 100 million euro transaction. And as a result of all those things, really leveraging our local presence, our capital, and our private lending capability, we were able to price a holdco PIK investment with mid-teens returns with quite modest or moderate leverage. So we're quite happy with that. But really away from that transaction.
That's something when you say to use the balance sheet, that's bigger than what you could have done in the fund. So you did it in the fund alongside the balance sheet.
Yes, exactly. So one of the things that I think that we're able to do quite well at Tikehau is that we have our fund business, but we also have in excess of 3 billion in equity, and so part of our balance sheet is available to enable us to move forward on transactions where the size and the timing is such that you have to commit quickly. And so, as many of us know, if you're able to commit quickly, solve people's problems, and run as fast as they are, then you have a good chance to originate very good pieces of paper, and that's really the case there. We're ultimately able to then bring in co-investors afterwards, but having that balance sheet enables us to be quite nimble even on larger transactions.
So the balance sheet extends the range of things you can do in the fund. It allows you to still do the small stuff that's appropriate to the size of the fund, but also to do the big stuff that you might get sized out of. And it allows you to do things quickly and then syndicate them out as co-invests.
Exactly. That's exactly right. So really the prime uses of our capital are really threefold. The primary one, right, is investing in our funds alongside our LPs. So for example, in our Special Opportunities Fund, which has a target size of 500 million and a hard cap of 750. Tikehau Capital has committed 150 million euros to that strategy alongside our LPs. And again, the alignment of interests is quite powerful. But away from that, we also have capital to enable us to, as I mentioned, complete transactions where it's necessary. So it's a very it's a very powerful asset that we have. And then maybe just quickly on the real estate side and in private markets, again, I think we're already being approached with a lot of requests, and a lot of these requests again are in sectors that are being quite heavily impacted, whether it's retail or hotel, for example. So in these sorts of segments of the commercial real estate market, I'd throw leisure in there, possibly office as well. Not many people seem to be using their office space these days. I see Twitter is saying they're not going to use any of it till at least September, for example. So I think in all those sectors, again, we're quite patient and we're going to kind of carefully look at transactions that we see, and obviously you can't go by what may have been valuations or projections that were produced before the virus hit. We'll look to take advantage of the improved pricing that we're already seeing, whether it's on the corporate side or the real estate side, and look to be well compensated for being a solution provider in real estate and in corporate. And again, what we try to do at Tikehau, I'm not sure I mentioned this, but we really try to lever the areas in which we're active, and also the geographies in which we know well. So again, we have these 7 European offices. We are very focused on investing primarily in those markets, and that's and leveraging the expertise of the firm in areas like real estate, direct lending, credit research, private equity. So that's really how we focus the business.
So how do you begin to invest in this environment, though? I know you want to be patient, but at the same time, you don't want to just pass on everything. And we don't know where the new equilibrium will be. We don't know when liquidity will come again. So what framework do you use to be able to make investments at this point? I mean, you want to do things that don't rely on a cure for the virus or the virus passing, but to some extent, everything does. To some extent, that's embedded in everything, even if it's at a very low level, right? So.
Yes, well, it's interesting, because again, in the first downdraft that we had, again, there were credits that were trading down in the 80s and the 70s that had no business being there, right? They were fundamentally good businesses. We were seeing telco credit, and obviously the virus it's on an overall base that's extremely damaging, and the containment, right? The containment efforts more so, I would say. But there are businesses that in some aspects, have more revenue and so forth. And so, so we found, frozen food businesses in France that were, trading down in the 80s, and their business was up 20-30%. Telcos are, obviously we're all working remotely. So anything that's related to kind of remote connectivity, there's certainly a lot of that going on around the planet at the moment. So certainly there were just absolutely mispriced securities. And certainly we've had a big rally, and personally, I do think, the markets are ahead of themselves and too optimistic, and I expect to see further downdrafts as sort of the reality of the impact sets in. And again, in that context, again, I think certainly on the corporate side, the fact that we cover so many names, and there'll be a group that will say we just don't think they're investable at the moment, and that's pretty straightforward. And then there'll be a group that will think it's just mispriced because those were businesses where the revenue streams are not materially impaired, but yet may have been impacted by the sell-off. And then the real challenge and opportunity, and really where people will distinguish themselves, is the kind of the vast majority of situations that fall between those two categories, where you're going to need to make judgments about the businesses, about how they're impacted by the containment measures, how they're impacted by any incremental public government sponsored debt that they may have taken on in the short term, and to really assess if you're looking at a bond or bank loan, how that particular instrument ranks relative to other obligations, understanding the business, understanding the industries, and really just doing your work. And it really will be, I think, the second downdraft where I suspect we'll see less of really good names trading down in the same way we did back in early March. This is really going to be the ultimate kind of stock pickers market, if you will, in the equity markets, and same in credit. And so there's going to be real opportunities for people who are able to access situations, do the work, and be able to make make good judgments.
And that actually feeds well into, we haven't talked much about what I kind of think is the most interesting part of what you guys do, which is the, I guess, bespoke private solutions, which, like you said, hasn't really come into play yet, but probably will later in this. So can you talk a little bit about that? I assume that's something that will come into play in that next downdraft, most likely.
Yes, no, I think certainly in the next downdraft, but I think also the private opportunity is going to last quite some time, because I think when after we get through what I think is just a kind of another market correction that's coming and may have just started the other day, there's going to be a very big need for liquidity and capital and, kind of reconstruction. And in some respect, it's almost like a post-war sort of rebuilding of balance sheets and so on. And it's one thing to survive the crisis, right? But you don't want to survive the crisis, come out the other side as a business, and then not have not have the credit and capital be able to grow, be able to respond to the demand as it returns and grows. And so we think that's going to be a very big, multi-year opportunity. And again, I think from Tikehau's perspective, I think our approach to that will be, again, we're going to be active in the businesses that we know well, in terms of being active in private debt, and in direct lending and leverage loans, and in real estate, in private equity, and the fact that we have this regional presence, which I think ironically now is even more powerful, right? So we closed this transaction last week. I think if you were a firm that worked from one office, say you're in Berkeley Square in London, and you had a European investing business, so holding aside Brexit, which everyone used to worry about, but now people barely think about, holding aside that aspect, you have the fact that you can't really go anywhere, right? So having people on the ground, having investing people on the ground in Milan, Madrid, Brussels, Paris, London, Amsterdam, gives you a real tangible advantage in terms of sourcing, in terms of having and building strong networks, seeing deals early, and I think all of those will really play to our advantage as we move into this next stage. But again, I think it's going to be a very, I think the private opportunity is going to extend for quite some period of time, and there's going to be, and it's also going to be an interesting environment. Historically, you've had, or certainly in recent history, we've had this very significant tension often between government and regulators and the financial industry. In this case, you're going to, it's going to be quite heavily aligned, actually, and you're going to see governments looking to support capital and credit provision. So I think it's going to be quite powerful.
No, we've seen that already. I mean, I've been talking to some people I serve with who run banks, and the governments have been very accommodating in terms of provision of credit. So
yes, I think we're going to see that continue, basically.
And that's what I was referring to. I think is what you guys do, which is interesting, is being not just reactive but proactive in terms of structuring. In terms of not just receiving a deal and bidding on it, but in terms of structuring a product that works to provide the liquidity that's needed. And I think that's going to be particularly useful for both sides in this cycle.
I agree with you. Absolutely. I think
so maybe talk about that a little bit, because people may not be as familiar with it. So.
Sure. No, I think again, the ability to know your borrowers, know the situation well, and be able to offer flexible capital, right? Be able to meet the needs of borrowers is really important. And again, if you can combine that with kind of local presence, and if you can combine it with kind of knowledge of strong knowledge and expertise in the segments that you're playing in, and the ability to move quickly, because I think one of the things that Tikehau has always tried to do is to be able to move as fast, run as fast as any of our situations demands, and then having the balance sheet to back it up when necessary. So I think that allows you then, in effect, to be able to trade on non-price terms, right? So you're able sometimes to win business, compete, create opportunities where pricing is not the primary determinant, and that just leads to better risk-adjusted returns for our investors. So we're very focused on that, and I think you're absolutely right. I think that, and I think you're like, because these are very unusual times and very unusual government measures that we're all responding to. And so on the back of that, I think if you are more flexible and you can anticipate and meet needs of clients that are, not needs that people have thought much about historically, then I think that can be quite powerful.
And it works for all constituencies, which is the important thing. And it works in hopefully helping to resolve the crisis, doing its part anyway to help resolve the crisis. And I think we'll see that more broadly, that there's going to be a lot more flexibility needed to get us out of this. It's not going to be just, that the markets are, that the markets are the circuit breaker, or the markets are the provision of liquidity to get us out of this, that the markets, we need flexibility in all sorts of ways.
Yeah, exactly.
So we've talked a little bit about the public and the private. What else haven't we covered in the questions that I guess the big question is, how does this crisis resemble and differ from previous crises? We've both been in the market since the 80s. We've been through a lot of them. People tend to think that, oh, you've been through one crisis, now you know what to do. Well, if you've seen one crisis, you've seen one crisis. I saw an interesting reference. Howard Marks in his letter referred to an MIT history professor an MIT engineering professor who, referring to logistics, he talked about, or to the supply chain, he talked about the Anna Karenina principle. And he was saying that, and it applies, I think, to these crises too. All good markets are essentially the same, and all bear markets, all crises are different. They arise in different ways. And so I think that applies here. There are commonalities to all the different crises, to all the other crises, but there are also big differences. And if you think, oh, I've been through this, and you try to play it the way that you've seen before, you can get yourself in a lot of trouble, but you can also learn lessons from the ones you've been through. So can you talk a little bit about sort of how you think you can apply lessons from, I don't know, 91, 94, 87 even, we can go on and on, right? But how you can apply lessons from the ones you've been through before and what you think is different and unique about this?
Sure, absolutely. I think it was yes. No, I think it was that great economic historian Mark Twain who said that history doesn't repeat, but it rhymes.
Yes.
And so Barry Eichengreen, who's arguably the best economic historian working today, kind of has a similar view that history is a quite imperfect guide to the future. It's never a crystal ball, but at least you can get some perspective from it. So if we think about prior crises, I mean, a few that strike me, and this is kind of putting on my LSE hat a little bit, is, certainly we had a pandemic roughly a century ago. And
was that again?
Yes, we had the Spanish flu, and so I don't think this plays out the way that one did, right? So certainly, that obviously came at the end of an enormously destructive war that had huge losses of life and capital, and led to instability politically and hyperinflation in Germany and other places, and a lot of other awful things that then followed on from that, in terms of intolerance and rising nationalism and so on. So I don't necessarily see us in a hyperinflation path, for one. So And also interestingly that, there's a lot of concern among some people who look back and say, okay, the Spanish flu, the second wave of infection was much more damaging and deadly than the first. So I'm hoping that in the last century that our public health and medical advances combined with technology and so forth will mean that's not the case. But certainly to me, it seems like we're going to need to live with this virus for some period of time, and that you're going to have to control flare-ups of infection over time, once you kind of, work through the first, wave of infection that we're currently doing, and now we're doing it in Europe and North America and elsewhere. Certainly the Great Depression and the more recent global financial crisis are, in some respects, maybe more useful ones to look at. And I think it's very much the case that, certainly when Ben Bernanke was running the Fed a decade ago, it was very much the case that, having policymakers who were familiar with the Great Depression was really helpful during the financial crisis, in terms of the scale of programs, of quantitative easing, of various measures that were taken. And we've seen that again. And thankfully, this time we've seen it both on the fiscal side and the monetary side, right? If we go back to the great financial crisis, there was a lot more hesitation by governments to provide fiscal support in that situation. And in this case, you're getting sort of both barrels, which is quite powerful. I guess that, relative to the current situation, the great financial crisis was more of a developed economy crisis, whereas unfortunately the pandemic now is really affecting us, everywhere. One other factor probably to think about is that we come into this crisis, actually, the banking sector didn't create the current crisis, right? And thankfully banks are much more tightly regulated and operate with a lot more capital than they have recently. And along with the alternative credit sector, again, are really a key to be able to help get us out of this crisis. And I think the growth in alternative credit, given the liability structure, very long dated, very limited liquidity, generally not mark to market sorts of terms, I don't see any bank runs. There's no Northern Rock situation that I would expect to see this time around. Financial stability is unlikely to be the issue. I think the issue that we're going to have is that we have this, interestingly, government-driven, policy-driven sudden stop to the economy in all these, countries. And you also have the behavior influencing, confidence damaging aspect that it's related to health, right? So it impacts, people's psyche, how they think, and what their behavior is going to be. And again, as we talked about, the recovery is going to be very incomplete and quite uneven. So when people talk about whether the recovery is going to be a V or a U, I don't think those are particularly helpful. I think the question is going to be, how long is it going to take to recover, right? Because after the financial crisis, we had a V, which is wonderful, but it took 5 years, right? Which is not so great. So if we're looking at 2022 or later for a recovery that's going to be quite bumpy along the way, then you need to, take that into account in terms of how you're underwriting, how you're going to underwrite, credit. I guess the other thing I would say is that when we emerge, because of the fiscal, which I think was generally very well done and massive in scale in many countries, right? We're going to have governments that are going to emerge with elevated deficits and elevated debt levels. And so certainly in the short term, the next several years, deflation is very much the major monetary risk that we're going to see. I think longer term, it may be the case for the first time in 3 decades or more, 4 decades, where you could see, under certain circumstances, you could see, more meaningful inflation than we've had since really since the early 1980s. because if you have this very significant quantitative easing that in growth of central bank balance sheets, and you have governments with elevated levels of debt, and you combine that with a reaction, a political reaction that encourages greater self-sufficiency and alongside sort of increased nationalism in some respects, that you could be moving into a less efficient, less productive market, more focused on reshoring and self-sufficiency. And that could lead to bottlenecks, that could lead to price rises, and ultimately to changes in people's perception of future prices. So
you're not worried about you're not worried about significant inflation out of this, though.
Well, certainly not in the short term.
Obviously not in the short term.
Inflation's our risk, absolutely.
But
I think it is the case that, if we are going to, some people have been predicting inflation for about 8 years coming off the back of the last crisis that obviously didn't materialize. But there is a scenario where you could see, certainly not high inflation, but inflation moving, certainly moving above, central bank targets for the first time in 12 years. And if you have sovereigns that have elevated debt levels, inflation is kind of alongside economic growth or default, that's how you exit high debt. So it wouldn't surprise me intermediate term more debt or more inflation.
I got jumped on by the hyperinflation camp yesterday on Twitter.
I'm not worried about hyperinflation.
A friend of mine asked, "What are you worried about in fixed income in this environment?" And I got there late and I looked at all the answers and nobody had mentioned inflation at all. And I said, I find it hard to be worried about inflation right now, but it does bother me a little that none of the responses here, that nobody is thinking about inflation. And then the response immediately was, what are you talking about? The hyperinflation cap is and I said, I don't think investors are worried about inflation. In policy circles, I think they're worrying about hyperinflation.
Well, I don't think hyperinflation is remotely on the cards.
I think in the policy world, they're worried about hyperinflation because of the magnitude of the stimulus. But I was curious about your.
Yeah, no, so I wouldn't, maybe just to wrap it up, I wouldn't share the view that we're heading towards a hyperinflation period. What I do think, though, is, we've been in a period where, really since the last financial crisis, of somewhat muted demand and inflation below target. And there's the possibility that might change. And there's also the convenience. Again, this is in the intermediate term. In the near term, deflation is still very much the risk. But in the intermediate term, there's a convenient aspect that inflation can help over-indebted countries, deal with elevated debt levels. But again, that's much later in the decade, and we'll see. Inflation has been undershooting expectations of a lot of smart people for quite some time, and certainly that's not the risk where we sit today.
I'm going to jump in here. We've got about 10 minutes left, and open up to Q&A. The first question we got is from a West Coast-based family office. And although Tikehau is a European-focused firm, I know there are global aspirations. And the question relates to strong multifamily performance and whether the nature of temporary government assistance is propping that up artificially. And maybe we could just get a little bit of your view on that one.
I'm sorry, on multifamily housing then? Is that what you're saying?
Multifamily housing. It's a real estate focused question. Yeah,
sure. Well, again, I think I think there's no question that these income support and furlough programs have they've been effective, right? And it's good, and it's good for individuals. It's good for the economy, but it certainly has masked the fact that as these programs ebb away, which they will need to do because they're obviously they're tremendously costly, that it'll then reveal a deeper level of unemployment and underemployment than maybe people are currently anticipating, and so so certainly there is that risk that there is that risk that that this unemployment will manifest itself much more materially in the in the second half of this year and into 2021, and that has implications for demand and would have implications for people being able to pay their rents in some circumstances. So it's certainly something to watch. And again, it's not something where you can easily look back and at prior experience to draw any conclusions from, because it's a fairly unique circumstance.
Okay. This one's from a Texas-based endowment, and they're wondering about how COVID-19, if it extends further than we expect, or if there's a resurgence, how that might affect how you might think about how assets perform in this scenario.
Well, again, I think the reality is that at the moment that's underpriced. I don't think it's priced into the markets, and I think that's the prime risk. I think that the prime risk we have is that you get extended, and that whether it's containment or whether it's a vaccine or treatments or other things, that these things take longer to be implemented, or maybe if there are vaccines and treatments, that the efficacy is not as strong as would have been hoped, and so on. So as I sit here, I see most of the risk to the downside, and I think you need to be underwriting to take that sort of longer tail into consideration in your in your analysis, because I think that's very much the the principal risk that we have.
The only thing I would say is, to your point before, it's maybe somewhat unevenly priced. There are some cases where securities are priced as if the world ends, as if the firm is more or less put out of business by COVID. So there are exceptions, but yes, in general, I agree that it's underpriced. It's significantly underpriced in the market and in most security prices.
Okay, time for one last question, and this relates to Tikehau, and it's a big firm, $28 billion under management. So you have a lot of assets that are existing, and the question relates to how your present positions are performing and how you are positioned to take advantage of the potential fallout.
Right. Well, I think that it's a very good question. I think the firm has has always had a very strong focus on downside protection, including in our private equity business, and so quite a contrarian approach. And I think that certainly we weren't expecting the nature of what caused this current correction and crisis, but we certainly felt that if, as we went through 2018, 2019, that we were very, very late stage, and financial asset prices in many places were didn't make sense to us, if you will. And so in that context, I think we've always been quite cautious. Like anyone else, if you have sizable investment portfolio, there are going to be some borrowers and portfolio companies that are going to be impacted in different ways. I think one of the things that we've been doing quite actively as a firm is being very, very close to our borrowers, very close to our portfolio companies, and working closely with them over the last several weeks, and so that is absolutely something we're quite focused on. I think going forward, again, I think we are I think we feel very fortunate from the standpoint that we have a lot of capital, that we raised capital over the last couple of years. We have a lot of dry powder in our funds, and we are trying to be very close to the markets in which we're operating in. And so again, I think that we're notwithstanding the near-term uncertainties and difficulties and challenges that each of us are facing, and collectively we're facing, that we see a lot of opportunity for us and a lot of opportunity in private markets, and we feel very well positioned to take advantage of them over the coming months and years.
That's great. So we have actually 4 more minutes before this actually will shut off. So Peter, do you have any last thoughts or anything to summary with, or before the end?
Well, no. Again, I think the last question you asked was quite a good one. I do think that that firms that have the ability to be proactive in this environment, and whether that's in our case capital, liquidity, our presence in the markets that we're in, there will be very significant opportunities as we move forward, and certainly in the special opportunities world, certainly that there'll be a lot of very good investments to be made, and again, I just think it's an environment that it's a different crisis than what we've seen before. The nature of containment is different, and therefore you can't just look back to what you did in the past or buy the dip, if you will, or whatever. It really is going to require fundamental bottoms-up analysis and making good judgments relative to sectors, relative to companies, and relative to where you position yourself in the capital structure in different situations. And for the people who can do that well, I think there's going to be very attractive risk-adjusted returns over the next several years here.
That's great, guys. We're going to wrap it up now. Thanks for the questions, everyone, and we look forward to seeing you on the next webinar.
Thanks, guys.
Thank you.